In this week's video, we'll review the latest charts and data to help us answer the question: what do these signals say about the stock market's upside potential over the next 5 years? The headline event this week was the Fed statement and press conference on Wednesday, September 17th. As widely expected, they cut interest rates by 25 basis points and, more importantly, signaled that most likely additional cuts are in the pipeline. Since we're fully invested, and we've been fully invested for some time, and considering the fact that the market is currently in an existing uptrend, one of our primary tasks is to monitor the health of that trend. We covered the chart on your screen in the August 8th video. The annotations are still relevant today. Chart on your screen, it's Fed Day, September 17th, 2025 at the close. Point of the exercise: the market could backtrack quite a bit here. It wouldn't do a lot of damage to the existing uptrend. For example, the AWAP here, tied to the prior high in February before the tariff scare, and the AWAP, the anchored volume weighted average price line, tied to the April low. Those lines in the present day are here and here. As long as price stays above those lines, it's easy to draw the conclusion that the current uptrend off of the April low is still intact, and we have numerous additional reference points. And if we were to look at them as of the close on Wednesday, September 17th, following the Fed meeting, the S&P closed roughly at 6,600. It tells us the market could fall approximately 3% to almost 14% based on the annotated chart that we covered on August 8th. And in that context, it still wouldn't have done much, if any, damage to the existing uptrend. And that's relevant because a 3% pullback to a 14% pullback, we know, is 100% normal and to be expected at some point in the future, even in the context of a secular bull market. These figures here are not a prediction in any shape, form, or fashion. We're not forecasting a pullback. We're trying to understand in advance, and that's the key, in advance, how to answer questions like this. If the market does this, how will we handle that? And given what we know today, for the most part, if the market backtracked between 3% and 14%, we would do very little. When you start to get into this window here, we would begin to prep for the possibility of mitigation 1. As you can see, as of the close on Wednesday, really none of these guideposts related to the existing uptrend have been violated, making it easy to classify this as volatility to ignore within the context of an existing and ongoing uptrend. And this is relevant because when we do this in advance, it's easier to stay with our profitable positions. All things being equal, in the context of a bull market, we would rather trade less rather than more, and we would rather create fewer taxable events relative to a higher number of taxable events. We have all of these guideposts. We can see them, measure them, and put them in a model. We know the context of a secular trend, the volatility profile of this secular bull market from October of 1958 to November of 1968. We know the volatility profile of the secular trend from 1991 to the year 2000. Is there anything else that's relevant and that can help us remain patient when we experience 100% normal and to be expected volatility at some point in the future? The answer is yes. History. JP Morgan, when the Fed cuts rates within 1% of an S&P 500 all-time high, they've done so 16 times historically. In every single case, 16 for 16, the S&P 500 was higher a year later from the date of the cut, average gain nearly 15%. Chart on your screen tells us we're still in an uptrend. The annotations on the screen tell us that if we experienced a pullback between 3% and 14%, that wouldn't do or cause any significant damage to the existing uptrend. A pullback between 3 and 14% wouldn't be out of character for a secular bull market. And within the historical context of the Fed cutting rates when the S&P 500 is within 1% of an all-time high, all of those speak to patience. The ability at this point, based on the evidence in hand, to err on the side of holding our positions until the weight of the evidence shifts in a material manner. Is there anything else? Yes. In last week's video, we covered 6 recent stock market signals that told us to keep an open mind about much better than expected long-term outcomes. And since we're using a weight of the evidence approach, this week we're going to cover some additional signals. The concepts are very similar to the concepts presented in last week's video. This is breadth data. This is Dow stocks, the percentage of Dow stocks above their 150-day simple moving average. Something that just happened. A rare oversold reading down here around 10%, and then a relatively rapid spike, aka a breath thrust, back above 85%, back to this blue line. Looking at all the data that we have going back to late 2001, something similar has only happened a handful of times. After the major low and after the dot-com bust bear market was OVER, 2003. After the major low and after the financial crisis was OVER, after a correction in 2010, after a significant drawdown in calendar year 2011, after the double dips in 2015 and 2016, on the friendly side of the COVID low, so after the COVID crash, and after the major low following the bear market in 2022. Thus, it might be helpful to ask and answer, how did the S&P 500 perform after a similar move? So when we hit the blue line here, how did the S&P 500 perform walking forward from this point, this point, this point, this point, this point, this point, and this point? The answer is extremely well. 1 year later, in every instance the market was higher. Median gain 16.2%, average gain 17.7%. Since we are long-term investors and we believe that we are currently in a secular bull market, primarily driven by demographics, we also care about the 3-year return after these rare signals. Very consistent. Average gain 3 years later, 41.45%. The median basically the same, 40% and change. What about 5 years later? Average gain a hair under 82%. Median gain a few ticks above 76%. Simply telling us to keep an open mind about a wide range of outcomes, including much better than expected long-term outcomes. It's very, very easy to see green tables and believe that the market is never going to go down again. We all know that's not possible. Volatility is a necessary evil. The ability to ride out volatility is a necessary evil if we're interested in capturing satisfying long-term gains and interested in compounding our capital long-term. We just covered breadth data related to the Dow. Similar data set here. Now this is NASDAQ stocks greater than their 150-day simple moving average. Here's your breadth thrust, your A to B move. It's noteworthy that we just hit the blue line in September of 2025. So this signal was just triggered, meaning the table is relevant. 1 year later, median gain 18%, average gain 17%. We did have the drawdown. Walking forward, eventually you have the COVID crash, very rare instance, a global pandemic, but also noteworthy. It helps us keep realistic expectations. It also reminds us that we're thinking in probabilities rather than certainties. 3 years later, average gain 48%, median 49%. 5 years later, average is 84, basically identical 5 years later with the median gain. 5 years later, every single case higher. 3 years later, every single case higher. And you may be saying, the stock market's always higher 1 year later, 2 years later, or 3 years later. That is not true. In the dot-com bust bear market, the S&P 500 peaked in March of the year 2000, and the bull market really didn't start until approximately 3 years later, after a retest in the spring of 2003. So in the dot-com bust bear market, you don't get a number that looks anything like these numbers shown on your screen. Similar concepts now, we're looking at breadth data. NASDAQ stocks, NASDAQ composite stocks, greater than our 200-day simple moving average. If you know your stock market history, 2003, 2009, 2011, 2016, 2019, 2020, all of these periods come after major lows or after a major correction was in the rearview mirror. This is a very strong move from a reading below 15% to a reading slightly below 50%. Chart on your screen is dated September 16th, 2025. Subsequent performance, very satisfying. 1 year later, 86% of the cases are higher, median gain 18%. 2 years later, the average gain came in at 36%, every single case higher. 3 years later, average gain 43%, every case green. 4 years later, look at the average and the median so close together. That speaks to some form of consistency in the data. Worst case scenario, 4 years out, a gain of 35%. 5 years out, median gain, a hair under 80%, with every single case that we have data for higher. And as always, we're looking at all of the data here that we have. We're not cherry picking. Here's some data that speaks to broad strength in the markets. This is S&P 400 Midcap stocks. The percentage of stocks making new highs minus the percentage making new lows. We have data going back to 2010. We are looking at all the data. You can see it's pretty rare in this limited data set to go from this type of oversold reading back to 5% here. In every single case, after the low here and here, after this Christmas Eve low, and after the COVID low. Something similar just happened in 2025. Chart on your screen dated September 15th. So you can see anecdotally and recently, it's been a bullish event. So does that mean we should go out and load up on mid-caps? It does not. After the Fed meeting, week to date, mid-caps, S&P 400 underperforming large caps, or the S&P 500, by 0.73%. This is a weekly chart. You'll notice, for the most part, it's making a series of lower highs and lower lows. We have a downward sloping 200-week moving average shown in red and prices below that moving average. Mid-cap performance relative to S&P 500 performance recently made a new 52-week low. It is an understatement to say that this chart, from our long-term perspective, has some work to do. And that absolutely positively may happen. It just hasn't happened yet. Thus, it's good for the S&P 500 and for large cap stocks that we're seeing bullish signals in laggards, such as mid-caps. Speaks to broad participation in isolation. Continuing with the weight of the evidence approach, data set NASDAQ 100 stocks greater than their 200-day simple moving average. We're looking at all the data that we have. It goes back to 2002. Move from A to B is rare. Subsequent stock market performance, when something similar has happened in the past, very satisfying. 1 year later, Market was up approximately 15%. 2 years later, over 34%. 3 years later, almost 44%. 4 years later, every single case the market was higher. Average gain 56.62%. Median gain 56.53%. So Wall Street Journal headline after the first full day of trading following Wednesday's Fed meeting, September 18th, Thursday's session. All the major indices in the U.S. performed well, but as noted on X, we're starting to get a little bit overbought, and this is as of Wednesday's close. The S&P 500's RSI stayed above 45 for 102 straight days, one of the longest streaks in history. Historically, when something similar has happened over the past 60 years, in every single case, 2 weeks later, the S&P 500 was lower. Average drop 2.17%, helping us maintain realistic expectations about how markets operate in the real world. Once again, when you see all these green tables, it's easy to believe that the stock market is never going to backtrack again or have a red session. We all know that's not possible. But let's make an assumption that this is going to happen, and the S&P 500 is going to drop 2.17% from the close Wednesday of this week over the next 2 weeks. For us, a 2.17% retracement, we know, is less than the retracement that we already covered back to the 50-day simple moving average. From Wednesday's close, that would be a retracement of 2.93%. And that's not particularly alarming. That means we would come back to this point here, and we all know that wouldn't really do any damage at all to the existing uptrend. Thus, it's important for us to understand even a sound and relevant study like this. We don't want to let something like this spook us out of our profitable positions, because a 2% drop over 2 weeks is something a trader would be interested in. We're long-term investors. And as we've covered last week and in this week's video, and as Jay points out, there have been numerous signals triggered over the past few months in calendar year 2025, including the one he covers here, that tell us historically the market's done well. In this case, 1 year later, every single case, the S&P 500 was higher. The average gain, 12.63%. 1 year later or 6 months later is a lot more relevant to our approach relative to 2 weeks later. Also noteworthy and offsetting, Bank of America came out recently and said that we're in a secular bull market that could last until 2029 or 2033. That probably sounds pretty familiar to regular viewers and clients. Why would they come up with a very similar target to our target, which is between 2034 and 2035? Because it's data-based. They're looking at the same historical charts that we look at and the same data that we look at, and they're drawing the same logical conclusions. So if the S&P 500 were to rally somewhere between, let's say, 2029 and 3033, that aligns with trying to remain patient and keeping an open mind about a wide range of outcomes, including much, much better than expected long-term outcomes. It's extremely important in closing this week to point out, we talk about being patient and trying to hold on to our positions within the context of an uptrend. That's relevant because by definition, an uptrend makes a series of higher highs and higher lows. And that implies that if we're patient during 100% normal and to be expected volatility in the context of an existing and ongoing uptrend, and if that uptrend remains in place, meaning the data doesn't shift in a material manner, then those that are patient will hold positions when they go on and eventually make a higher high. And when the market makes a higher high, Given the positions that we hold today, most likely the balances of our accounts will also make a higher high. And that's important because the objective of all of this is to make money. So really what we're doing this week from both a bullish and bearish perspective is we're looking ahead and we're considering numerous outcomes. And that allows us to mentally prepare in advance. We don't want to get caught off guard if the market falls 2% over the next 2 weeks. And we don't want to get spooked out of our positions if the market comes back eventually and tags the 200-day moving average. We want to continue to make decisions based on the weight of the evidence. And we all know the only way that we can use the weight of the evidence effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.